The Dow Jones Industrials just lost all gains for 2018.
The largest single-day point drop ever.
What's going on? The sky is falling! The sky is falling!
Hey dudes, hey dudettes, and everybody in between, welcome to my channel where my goal is to help 1,000 people manage $10,000. The reason why I'm doing this video is the market has been falling, and it has been falling quite badly. It could be a correction, it might be a long-term trend. At this point, honestly, I don't know. I'm here to explain the 3 reasons why I think the market is falling, and hopefully it's going to be beneficial to you to understanding the market, and also it helps you think about what opportunities there are in the market. Okay guys, before I start, I just want to say again, this is not financial advice, it's just my opinion and why I think the market is going the way it is. Okay, so first I need to address what the popular news channels are saying. On my phone, I always get the CNBC alerts and they say it's due to the interest rates. Okay, so this was what happened in December, as you can see here, December 13th. The Fed raised interest rates again, and this is the 4th time they did it last year. So interest rates are affected because of something we call, okay, this is the risk formula for alpha and this is for CAPM. So in finance, we use these to evaluate stocks and assets and all different kinds of things. What we expect a return from an asset, and what we take into account is just what we call risk-free rate, which is the, if you were to put no risk out in the market, how much you would theoretically get back. So in most cases, this is the US Treasuries. So because they raised the short-term interest rates, the long-term took a while to pick up, but now it has. The 10-year treasuries have kind of gone up, and I'm going to show you that later. And because of that, all assets should in theory price lower. Okay, I just need to give a kind of a quick plug because I actually said this last year, beginning of last year, on my blog back in January, that interest rates was the reason why I thought the market was, so January 2017, the reason why I thought was the offshoring US stocks was because the interest rates were rising. Of course, this only happened this year, so in between I did lose quite a bit of my capital. I lost about 5% on this trade. I don't intend on going back in for that reason. I don't intend on shorting again for that reason. But why it happened so suddenly, honestly, I don't think anybody can tell you. And they can, they're probably, full of it. So that should have happened back in somewhere around December. So why is it happening now? The truth is, I don't know. We know it should happen, but it didn't happen in January. As you can see from the S&P, it actually ran higher in this, from January onwards, even when interest rates rose. And then suddenly we had this market correction, and this was really last week, kind of start of this week. Okay, and I want to get into the second reason, which is the VIX trade. VXX, VIX, XIV, these are all instruments that basically play on volatility. And the reason why it is very well covered in the macro community. So I did talk a little bit about it on my wall. You can go read up about it if you have the time. And Zero Hedge also did an article about it, and I've already linked it, and it's also on my wall. It is a very crowded trade because a lot of pension funds and a lot of people are into it. I'm not sure if you guys have heard, there's this famous Target manager who made a lot of money just shorting the VIX. He started his own hedge fund, and now he's probably, I don't know what's going to happen to his fund. So in brief, what happens is that when you short the VIX, what you're doing is you are selling, we call it selling volatility. So you buy kind of this contract, 11.39, and in 1 month it is going to be worth this much. Okay, so you're going to make this difference just by holding on to the contract. So if you buy it even a bit further out, something like here, and you just wait for it for the next 5 months, 1, 2, 3, 4, 5, you make this difference in the spread. So this has been a very popular trade, and it's very simply because the market has been moving in one general direction. It has not reversed in any way. So because of that, we have a very, if you look at the VXX, which is probably the most popular instrument, if you bought it in 2000 and let's say 10, you bought it at $34,357, you shorted it, if you kept it, it would be worth $55 now. And in terms of return, that is just, I mean, it's off the charts, and that's the reason why this trade has been so popular. So now that this trade has unwound, it is affecting the stock market quite badly. And the reason is also because in order to unwind this trade, you need to sell sell stocks into the market just to balance that out. So it's a complicated relationship. I don't want to explain it here because it's going to get very, very long. If you want to know more about it, just let me know. I'll provide you the links and you can go read up about it. Okay, so the third reason is computer driven. So what they are saying is the stock market plunges because of all these computer driven. So I couldn't explain this to you without explaining the previous part, which is the VIX, and a lot of the reason is because of this volatility targeting. Okay, so what happened is that volatility targeting says that you will, let's say you have a ratio of 1:2. So bonds don't move as quickly as stocks. So you have 1 unit of bonds and 1 unit of bonds, 1 unit of stocks and 2 units of bonds, so that you reach the same kind of risk level. Okay, so you lever up your bonds to make it 2, and then your stocks is 1, so that's parity. Okay, so you lever your bonds to become 2:2. But what happens after the VIX has spiked? The ratio becomes 1:5. Your bonds move 1, your stocks move 5. So the only way to balance it out from 2:2 is, and you want to go 2:10 because of the difference in volatility, is you have to go and sell stocks. So what that did, if you go and read some of the articles online, okay, so this is an article here which talks about like how much exactly went into balancing this. Again, I won't go into it, it's very complicated. I have a video which I'll link up in the corner here, that I actually was interested in becoming one of these risk parity funds. So I am guilty of trying to replicate this strategy, but I didn't because of various reasons. I won't get into it again. Okay, so another problem that I'm seeing in the market, which is the biggest risk for me and my copiers or investors on eToro, is correlations don't seem to be working. Previously, what happens if stocks went down, gold will go up, rates will go up, and overseas markets, they will have a little bit of effect. You expect a certain correlation, but when I was looking at the charts, I really don't see this. This is the Pro Charts by eToro, which is a great tool, by the way. So over here, which you can't see because of my face, is the Euro stock market is falling. Same amount as the SPX actually. Same degree of volatility as the SPX. So gold, you expect it to go up. It has not really gone up a lot. It has come down, in fact, which is a little bit weird. You don't expect this. US dollar, which is traditionally the safe haven, has appreciated, but not by much. This lack of volatility kind of scares me. So of course, we talked about the VIX. Okay, the interest rates, like I said, TLT is the long-term treasury ETF, which I sometimes use. But as you can see, it has also fallen along with the stock market. So yields are not coming up at the same time as the stock market is coming down. So we are in a little bit of uncharted territory or uncharted waters. The correlations may eventually find themselves, and I expect them to, but at the moment they're not quite there. Okay, so the question is, what can you do now that all this has happened? Well, I have 3 recommendations. Go long, go short, just wait. Okay, so these are just kind of the only things you can do in any investing market. But when I say go long, I would say go long stocks that you think have real good value and they've dropped, so they've become cheaper. How you going about valuing these things? I use a different method from most people. I am a fundamental investor, so I do discounted cash flows and all that. I don't expect everybody to know how to do it. It's kind of complex. It takes a bit of training and stuff like that. Unless there are stocks that you really, really, really like and you know that they're probably gonna go back to the highs, then yes, that's a good idea. I would stay away from tech stocks, to be honest, just because even at the corrected levels, they are still fundamentally very overpriced. I know a lot of people are very interested in tech stocks, but it's one of those things. You can go short, which is, I would recommend going short a broad index if you expect this to keep going. because if you look again at individual stocks, there are very specific things you need to look at, especially as a short seller. It's a very painful thing to do. Honestly, I don't know how to do it. I tried it last year and I lost 5% of my account, so I'm not touching that. Okay, and the third one is just wait, which is mostly what I'm doing. I have one position open right now, and that's dollar CAD. I lost quite a bit of money trying to go long the Chinese stock market. I like the fundamentals of the Chinese stock market, but volatility has completely wiped out 1-ish% of my account. So I'm not going to touch that for a while. I'm just going to wait and see where we go. Okay, I need to talk about this because this is going to affect anyone who copies me or anyone on eToro for that matter. I am concerned that if the VIX does not go back to the levels it has previously, that there is going to be a pension crisis. What I mean by that is we have an aging population. This is true across the board. The baby boomer generation has a lot of people and they are all retiring. When they retire, they spend less money, there's less money in the economy, and a lot of their money is tied up in pensions. And pensions promised 20 years ago that they can get 7% return, and the way they've done that in a low interest rate environment is to short the VIX. And there's a great paper here which is Everybody is Doing It. It's written by this guy and this guy, so both PhD holders, CFA holders. You can see they are actually investment officers as well. And they are talking about how crowded this trade is and who's into it, and you can see it's a lot. So it is a black swan event for me. I don't know the degree or how drastic it is or how many people are in it, but I am cognizant of the fact that if this is real and the VIX is not returned to normal and there's no government bailout, this is going to be serious. One of the reasons I think this may be a black swan is like Grant Williams, which I follow closely on Real Vision because of Real Vision. He says it's on, which is the depression's on seemingly out of nowhere, just as we expected. And a lot of people like to say that now in the modern era things are different. Let me just stop you there. There is a book called This Time Is Different. It's written by these two people, and it is a great book. It talks about all the crises that have happened before, and it's important to study crises if you want to avoid the next one. And there's no way of telling when it's going to happen. You know the effects, but you don't know how to time it exactly correctly. So that's what this book is about. Okay, and that's all I have. I hope this video isn't too long. I think it is. So I hope you liked that video. Do me a favor, like, comment, subscribe, or watch a video recommended by YouTube here, or watch one of my videos here. Thanks.